This is Fred Oltarsh coming to you from the trading desk at Libanman Futures. Here to discuss our daily options and futures data and statistical review, which we present every night. And it's received quite well by traders of options and futures alike who are interested in attaining information that they don't get elsewhere. So I'd like to just show you, it's on a 3-section chart here, and I'll go through some of the numbers just to make sure that everybody who's going to get this report or who already is getting it and may not understand exactly what they're seeing, give them an opportunity to understand what all the columns are. So on a daily basis, we follow the following contracts, symbols on the left: coffee, sugar, cocoa, cotton, orange juice, the dollar index, crude, heating oil, gasoline, natural gas, gold, silver, soybeans, soy meal, corn, wheat, live cattle, lean hogs, the S&P, the NASDAQ, the Dow Futures, and the Euro. So those are the contracts I'm following on a nightly basis for you in this informational package. And then we follow the following factors. We follow the last trade of the day, the net change, the percentage net change, the day's high and low, and the range. And then we give you the dollar value of that range. And that we find very useful, because if you're trading really small contracts, it's that much harder to make money based on the fact that there are commissions and there's an element of slippage. So if the contract really isn't moving that much, it makes it sort of hard to make money. In any event, so that's what the daily range is. The 20-day average trading range is given next, and then the dollar value of that 20-day average trading range. So as you'll see, although there is an error in this, the gold has a number of 13,000. That's actually 1,300 per day. In any event, that will be changed on a daily basis, so you won't see that anymore. But as you can see, really, coffee is very volatile, or moves around a lot. The S&P has a very good range. The NASDAQ has a very good range. The Euro has been having a good range. So these are all big contracts. Crude oil has a nice range. So these are all contracts: crude oil, heating oil, gasoline, and natural gas. These are some of the bigger contracts. So it makes it easier to put on a position there and experience gains and not have other areas like commissions be such a big part of your transaction. The relative strength index on the far right gives you an idea of whether the contract is either overbought or oversold, and it's a numerical number, clearly. If you look at corn, for example, the relative strength index is 80.74. Anything over 70 starts to look like it's a little bit overbought. Anything over 80 is obviously more influential, and over 90, which rarely occurs, tends to show an overbought situation. Although, you know, contracts that trend higher and continually move up, which we've seen recently in cotton and sugar and coffee, will show these higher numbers, and doesn't necessarily mean that we're going to see a retreat in those contracts. Sometimes you see a temporary retreat, but it's hard to get. If you get short, you can often get caught and you can't get back. In any event, that's a relative strength index. So that covers the first page. On the second page, we look at today's dollar move of the contract. And if you go down that column, you'll see the S&P again had the biggest dollar move. It's a big contract. They do trade the mini, so that's a fifth of that. So you can get an idea of how that's moving. Crude, heating oil, gasoline, natural gas, those were some of the bigger moves today. You know, coffee is often a big move, but not today on this chart. Secondly, we see margin on historical and implied. That is giving you an opportunity to get an idea of what a margin would be if somebody were using an equal weighting of the 30, 60 historical volatility and the implied volatility. And what we do is we calculate the margin requirement for the contract based on those factors. So you can see it's not necessarily the margin requirements of the exchange. It just gives you an idea of a level that might be reasonable for the movement on a 97% confidence level for that market. If you move over two more columns to implied volatility, it gives you the margin on just the implied volatility. So the coffee contract is about 3,500 for the historical and the implied, but if you use the implied, it's almost 4,000, giving you an idea that the market itself, based on implied volatility, is collecting more. And that's the case in most of them, because in most cases, the implied volatility is trading higher than the historical volatility. Excuse me. The contract value is listed next to the margin on historical and implied. And for coffee, it's 71,175. And you'll get an idea of what these contracts are worth. And then, you know, the larger contracts obviously give you the more leverage and you know, make it easier to trade as a percentage of commissions. Now, margins as a percentage of contract value is the next contract column. In coffee, for example, it says 4.9%. That, again, is based on the historical implied margin as opposed to the one to the right, the implied volatility margin. And that gives you an idea of how much money or leverage you have in percentage terms. We'll skip over two more columns to the open interest and the volume, which is pretty much understandable. And then the skew. And we've provided a skew in this so that you get an idea of which end of the option curve is trading more expensively. So, for example, in coffee, the calls are trading much more expensively than the puts. Same with sugar. In cocoa, it's basically a bell curve. At the money is less expensive than the wings. And on the way down, you see how they're all set up. Crude oil has a put skew where the puts are much more expensive, the calls get cheaper. S&P is like that. And we provide you with this skew because it's a very important way of coming up with options, techniques, or ideas to satisfy certain goals that you may have. If you have a bias in a particular market like coffee, the skew can help you design a strategy as a good way of getting long or short that contract. The next thing is the contract in itself in a written form, so if you get lost, you can see what it is. Finally, on the third page, we have quite a bit of information pertaining to the options. We have the options Ds to expiration for the month we're looking at. Gives you the call delta and the put delta for the options that are in the middle of the page, which gives you the settlement price of the call and the settlement price of the put, and those are at the monies. Gives you the theta, the vega, and the implied volatility change for the day. Implied volatility change for the day is certainly very interesting, and you want to know that. You want to know which way the implied volatility is going, and you need to know that. If you look, there are some fairly large, sizable moves. Soy meal down 4.5% almost, corn down 3.5% that particular day. Then it gives you the settlement price of the call and the put. It provides the 10, the 30, and the 60-day historical volatilities, give you an idea of how the market's moving, how it's moved in the past, what would be a reasonable way to look at it over a longer term than a one-day move, and then the average implied volatility. That's basically the implied volatility of around the at-the-monies for that contract. In coffee, we see 40.93. As you can see, the differential, which is in the next column, it's 2.94 vols over the 30-day historical. And it's 5.68 vols over the 60-day. Now, if you look to some of them, you can see cotton is trading quite a bit over the historical volatility. The OJ average implied volatility is 40, and it's trading almost 12 or 14, depending upon whether you're looking at the 30 or 60-day differential. Now, all of this information is really valuable when examining options, values, and establishing positions, and giving you an idea whether you would want to be long volatility or short volatility, or whether you, instead of maybe buying calls, would want to buy call spreads, so you're not long a lot of volatility, you're just long the market. It gives you an opportunity to really decide and look with great scrutiny as to how you can develop a position that makes sense for your goals. Always you want to look and see what your market sense is. Do you want to be long or short, or do you want to be long volatility or short volatility? And then from there, you can use this information to help guide you in a direction that can establish a good position. I spend days looking at this and analyzing and trying to figure out the best opportunities to go long or short in each market, and whether you're willing to take some more risk by being naked options, or whether spreads are the best thing, and that really depends on your risk-reward ratio. But I often have ideas based on the options markets as to what I believe would be a useful way for people to take their market biases and put it into effect. So if you have an opinion and you'd like to discuss it, feel free to give me a call. I'm always interested in what you have to say, and maybe I can add some insight into how your position could be profitable, hopefully, and most importantly, get good value doing it. This is really a review of my options and futures data and statistical review. It's available every day on the web at www.libanman.com. We'd be happy to add you to our email list for this daily report. And in addition, I'd be happy to discuss or review anything that you may have missed in this discussion. So I hope your trading has been successful, and I would look forward to working with you on options trading. My background for 15 years on the floor as an options market maker, trading oil and coffee, sugar, cocoa, cotton, and orange juice, as well as stock index futures and the U.S. dollar index. And then I was head of risk management at the New York Board of Trade ICE Futures for 7 years. So I have a fairly long background in options trading and managing risk, and I would be interested in sharing that with you. So I hope you've enjoyed this presentation, and I look forward to hearing from you. Thanks very much.